Today on the Daily Deposit we will discuss how the recent bank failures will cost the FDIC $23 billion. It expects large lenders to pay. According to people familiar with the situation, the Federal Deposit Insurance Corporation, which is facing nearly $23 billion in costs as a result of recent bank failures, is considering shifting a larger than usual portion of that burden to the nation's largest banks. The agency has stated that it intends to propose a so-called special assessment on the industry in May in order to shore up a $128 billion deposit insurance fund that is expected to suffer losses as a result of the recent failures of Silicon Valley Bank and Signature Bank. Under political pressure to protect small banks, the regulator has stated that it has discretion over how those fees are set. According to people familiar with the discussions, officials are working behind the scenes to relieve pressure on community lenders by shifting a disproportionate share of the cost to much larger institutions. That would add to the multi-billion-dollar bills already owed by J.P. Morgan Chase & Company, Bank of America Corporation, and Wells Fargo & Company. The KBW Regional Banking Index of 50 lenders rose 0.6% in New York on Wednesday after Bloomberg reported the FDIC's internal deliberations. Large bank shares lost ground but recovered by the close of trading as the market rallied. The size and timing of the assessment are currently being discussed. Leaning heavily on large banks is seen as the most politically acceptable solution, according to some of those who asked not to be identified because they were discussing private matters. The FDIC, J.P. Morgan, Bank of America, and Wells Fargo all declined to comment. The question of how to spread the cost of SVB and Signature's failures is already a hot topic in Washington, where lawmakers have pressed FDIC Chairman Martin Gruenberg, Treasury Secretary Janet Yellen, and Federal Reserve Chair Jerome Powell on who will bear the burden, particularly after an unusual decision to backstop all of those banks' deposits. The extraordinary measure saved tens of thousands of tech startups and wealthy customers whose balances far exceeded the FDIC's standard $250,000 coverage limit. Extremely sensitive. I'm concerned that Arkansans will have to subsidize Silicon Valley Bank and Signature Bank deposits, as well as possibly others that come forward, Republican Senator John Boozman told Yellen last week during a hearing. Will the special assessment be levied against community banks? She assured him that the FDIC has discretion in determining which banks will pay. When asked about the strain on community banks, Gruenberg added, "We're going to be keenly sensitive to the impact. We have the authority to tailor that assessment to the institutions that have benefited the most directly." The debacle that brought down SVB and Signature Bank was, in some ways, beneficial to the nation's largest banks. Both of those lenders had taken in billions in uninsured deposits that turned out to be volatile, forcing them to incur losses in hasty asset sales. Customers at small banks across the country moved cash to large banks as a result of the fallout, showering those lenders with cheap funding. Every quarter, banks contribute to the FDIC's insurance fund by accepting deposits that qualify for the agency's protection. Banks profit as long as they find new ways to earn money by lending it out or investing it. Fees charged by the FDIC vary greatly. The Dodd-Frank regulatory reform of 2010 required the agency to consider the size of a bank when setting individual rates. The complexity of a firm and its confidential regulatory ratings can also play a role. This means that a large bank not only pays more because it has more deposits, but also because its interest rate is higher. When the FDIC's main fund suffers a blow, the agency can levy a special assessment to expedite the process of replenishing its coffers, and it can customize how those rates are set. In addition to determining which firms benefited, officials may consider economic conditions, industry effects, and such other factors as the FDIC deems appropriate and relevant, Gruenberg said in written testimony to the Senate this week. When the agency is ready to propose a formula in May, he said, it will solicit feedback from all stakeholders. Political influence. On Capitol Hill, lawmakers have publicly demanded that regulators exempt small banks from having to pay for the extraordinary intervention at SVB, which rescued what Senator Patty Murray referred to as its very wealthy depositors. You're creating the need for a special assessment that will be imposed on those well-managed community banks that didn't take those risks, the Washington Democrats said during a hearing with Yellen. Murray pointed out that many small banks serve people with much less money. Leaning on large banks can quickly add up. When the FDIC announced a special assessment to raise $5.5 billion in 2009, J.P. Morgan said the surcharge took $675 million from its second quarter earnings. The impact of SVB and Signature could easily exceed that. The agency estimated Sunday that SVB's failure will cost $20 billion, in addition to the $2.5 billion hit from Signature. It is unclear how quickly the FDIC intends to collect the assessment. Recently, some large banks have been under pressure to help First Republic Bank, another troubled lender, shore up its balance sheet. For the time being, regulators are giving that bank more time to reach a deal to strengthen its balance sheet, according to people familiar with the situation. However, after speaking with government officials, some Wall Street executives believe that even if their companies do not inject more equity into First Republic, they may be held liable in another way, paying into a special FDIC assessment if the agency intervenes. There is your deposit. If you like stories like this, please hit the like button and subscribe. Don't forget to hit the bell icon so you can be the first to get all my new material when it deposits.